Are you an optimist or a pessimist? Do you see your financial future as glass half full or half empty? It's an interesting question to think about, and if behavioral psychology has taught us anything, it's an important one to consider too, because our perspective on things can influence our behavior in ways that we may not realize at first. Here's the thing though, both financial optimism and financial pessimism can be extremely problematic if they allow us to venture too far from the confines of reality. Today I'm going to be going over why that is and why it makes financial pragmatism so valuable. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a 30-day free trial of Audible and 2 free audiobooks of your choice, as well as a list of some books on money I'd recommend checking out with your free trial. Optimism, at least in the context of personal finance, often sounds like a sales pitch, if not an outright scam. And sometimes that is the case. There are financial scams out there. But other times, most of the time really, this reaction is just an extension of our own financial cynicism or some sort of financial defense mechanism. Pessimism, by contrast, often sounds a lot more like someone that's just trying to help you. Perhaps that's one of the reasons why it's so seductive. And, just like with financial optimism, sometimes this financial pessimism is absolutely warranted. One example would be if we miss a variable that someone else spots as we're discussing our financial plans. Them pointing out how our plan is doomed to fail as a result of this oversight is an enormously helpful observation, even if it can be a little embarrassing in the moment. However, other times, this pessimistic viewpoint is also just an extension of financial cynicism, projection, or some sort of defense mechanism. And if taken to an extreme, financial pessimism of this kind, the kind that is taken to an irrational and/or emotional extreme, can be detrimental to our financial futures, in large part because it can encourage apathy and inaction. Let's take a look at how this can play out with a few examples. One area that comes to mind where financial pessimism can be particularly detrimental is in our investments. While it certainly is possible to profit as an investor through your pessimism, either by getting out of the markets shortly before a crash hits or by trading options successfully, it's certainly not easy. History has repeatedly shown that timing the market, in any way really, not just in terms of trying to predict the next crash, is incredibly unreliable. Statistically speaking, the markets are up more often than they're down. Historically speaking, we can verify this by looking at the daily returns of a market index, like the S&P 500. Doing so will allow us to see that the markets are up, or at least steady, roughly 54% of the time, and down the remaining 46% of the time, at least since 1928. And that's just in terms of raw price data. It doesn't factor in dividends or anything else. Unfortunately, the intensity of the feelings we get from watching our net worth grow slowly but steadily over time does not come close to matching the intensity of the feelings we get from seeing that relatively rare, although inevitable, sudden market crash. So it's completely understandable that people have tried to find ways to avoid the worst of those market crashes. But I want you to take a look back at the odds for a minute. They suggest that trying to profit as an investor through this pessimistic approach would be the less likely outcome. Sure, in the real world there are models and formulas to try and stack the odds a little bit more in your favor than that probability would suggest, but they also aren't always reliable. And even if they were, many casino games are built on giving players odds that aren't too far off of that. So it's not surprising that most people who try this approach end up failing and either give up on the approach or, after being burned one too many times, give up on investing altogether. And that can be incredibly costly. We don't need any more evidence for that than a simple graph showing the impact of compounding interest on an nest egg. Here's one showing the growth of a $10,000 investment over the course of a 40-year working career, assuming no ongoing contributions and 10% average annual returns. Here's another graph showing that growth, but with $500 a month contributions. Even if we took a little bit more of a pessimistic view about our long-term returns and assumed a 5% annual growth rate on average, the results are still pretty darn extraordinary. According to the 4% rule, that level of cash would be enough to sustain a $33,600 a year income in retirement. A second area that comes to mind where financial pessimism can be particularly detrimental is in our approach to debt management. If you believe that your financial future is going to be bleak no matter what you do because the government's going to screw things up, or your boss isn't going to let you get ahead, or whatever the case may be, then it's much easier to talk yourself into decisions that are meant to maximize short-term enjoyment at the cost of your long-term future. Yes, this. Spending beyond your means and accruing debt as a result is generally considered a bad thing to do financially because eventually the bill is going to come due, especially if the debt that you acquired was of the high interest variety, which many forms of consumer debt, most notably credit cards, are. And when that time comes, you may not be able to pay for it, essentially turning your pessimism into a self-fulfilling prophecy. But if you believe that your future is doomed anyway, you could see how financing purchases for things that you at least enjoy in the here and now can be so tempting. A broken future only matters if the future had a realistic potential to be good in the first place. For similar reasons that extreme financial pessimists may rationalize things like accruing excessive amounts of debt, they also can rationalize not prioritizing its payoff, which can be detrimental to our finances over the long term for the exact same reasons that we just covered in the section on investing. Compound growth doesn't just apply to investments. It applies to any instrument that sees its value regularly appreciate based on its current worth. Financial debt is one of those instruments. So basically, look at the graphs from the last section and add a negative sign on every net worth figure. That's the potential damage we're talking about here. A third area that comes to mind where financial pessimism can be particularly detrimental is in our budgets. Believe it or not, pessimism when it comes to planning out your spending can be a good thing to have in certain circumstances, particularly when it comes to protecting yourself from negative external forces. Someone who has a healthy amount of financial pessimism will see the value in things like having a fully funded emergency fund, because they know that eventually an economic downturn will hit and they'll want to be ready for it when it does. That's absolutely a prudent thing to do. But by now, I think you've probably figured out the pattern. If you are irrationally pessimistic about your financial future, it's easy for apathy to set in. And if financial apathy does set in, you might start asking yourself questions like, what's the point of restricting yourself with a formal written budget in the here and now? Or why limit yourself to spending less than you make in order to save money if that money is not going to be of any use to you down the road? Now, I would argue that there still is benefit in working with a budget of some sort, even if you don't believe that there will be any use for your savings down the road, because increasing your financial awareness, in this case by tracking your expenses and maybe even keeping some sort of a journal to identify what items are punching above their weight, so to speak, in terms of your enjoyment per dollar spent, can help you make more out of what you currently have, even if it is just focused on the here and now, but I digress. If you're not working with some kind of budget, or even just tracking your expenses in general, then you are running an elevated risk of living beyond your means. Don't get me wrong, there's no guarantee that you'll ever get to that point. There are some people who can genuinely run a pretty tight financial ship with or without a budget. But generally speaking, the risk of you one day overextending yourself financially is a little bit higher if you're not keeping tabs on those things than if you were regularly checking in on your financial status. And we've seen over the previous two sections how much that can impact your finances over long periods of time. Lower financial awareness often leads to lower financial efficiency, which often leads to less savings and more debt, which leads directly to less good compounding growth and more bad compounding growth. So that's the potential problem of being overly financially pessimistic. You run the risk of eventually coming to a point where financial apathy starts to take root, which can alter your worldview and decisions going forward in a negative way. However, you can also go too far in the opposite direction and become excessively optimistic to your own detriment. The problem with financial optimism, at least when taken to an irrational and/or emotional extreme, is that it has the potential to lead to unrealistic expectations, a thin financial skin, and risky decision-making. Take a look at the investing hypothetical we just went over as an example. Optimism as an investor can be a great thing to have. It can oftentimes help you keep your skin in the game during struggling markets. And as we know from history, times when the markets are struggling are some of the most crucial to sustaining long-term financial success. Because on the one hand, selling your investments when they're down locks in those big losses permanently. On the other hand, continuing to invest when the markets are struggling is often one of the best things you can do to ensure long-term financial success. Buying the dip has been shown to be effective after all, at least when applied to broad-based and well-diversified investing strategies. However, if you have an excessively and/or irrationally optimistic view of your financial future, you may become blinded to the fundamentals of an investment that you buy into. This could make you an easy target for financial scammers scammers, Ponzi schemes, or just regular old financial hype trains. Think of the people who invested with Bernie Madoff, or the people who fell for the tech craze of the late 90s, or any number of other financial calamities that led to people losing everything. Most notably, all the time that it took to build the fortunes that they had before the bottom fell out of the investment. Irrational financial optimism can be devastating for our investments. And when you couple that with the potential for it to be shattering to your worldview, you can understand why it might be difficult for such a person to immediately jump back into the markets as if nothing bad ever happened. Debt management plays a similar role. If you are irrationally optimistic about your financial prospects, you may be tempted to take greater risks and use greater amounts of leverage on various aspects of your financial picture, like your investments. Now, if things break right for you, this can be enormously profitable, since leverage allows you to basically multiply your gains. But if things go wrong, it can be monumentally devastating for the exact same reasons. This is why approaches that use high amounts of leverage are generally considered to be more risky than those that don't. A healthy amount of optimism when it comes to budgeting and saving money can also be a great thing. It can help you take those first steps of trial and error, which are often the most difficult to work through simply because the process is so new and you don't know what you don't know. However, when taken to an extreme, you can again blind yourself to the reality of what the day-to-day experience will be like. As I just said, it usually takes a fair bit of trial and error, as well as flexibility, to dial in and maintain a budget for the long term, especially if you're building a budget with someone else like a significant other, since learning how to communicate with each other to work together effectively on your finances takes a lot of time, effort, compassion, understanding, and experimentation. Someone who's overly optimistic about this aspect of their finances may end up harboring unrealistic expectations about what it's actually going to take to make this work over the long run, and therefore may not have the perseverance or thick skin needed to push through the barriers that we all face on our journeys to becoming better money managers. As a result, they could find themselves becoming disappointed with their progress and disillusioned with the budgeting and savings concept entirely. So, yeah, excessive and irrational financial optimism can be less than ideal. The same is true of irrational and excessive financial pessimism, but as we've just seen, a healthy dose of both can be very useful in different circumstances. And that's where the value of financial pragmatism comes in. Pragmatism is simply a way of tackling a problem as sensibly, reasonably, and realistically as possible. When you're trying to be pragmatic, you're trying your best to look at things as they are, as opposed to how you might want them to be. Now, we can't always piece together these realities perfectly. I mean, if we could, then the risk associated with leveraging your investments wouldn't actually be risky because we'd know what's coming before it comes. But because we know that, we can adjust for our own lack of omniscience. These adjustments can help us to avoid becoming too optimistic or too pessimistic in any given situation, and as a result, hopefully allow us to make better financial choices. So for instance, when it comes to choosing our investments, a realistic pragmatist would not be trying to maximize their gains per se, because in all likelihood, the goal is not to get to a point where you can live a lifestyle full of fancy cars and endless luxury. The realistic pragmatist would realize that, at least for most people, such a lifestyle just isn't as fulfilling as it might seem from afar. The goal would be to have enough to live a reasonably comfortable lifestyle with the time and energy available to focus on the things that really matter to them. And if you end up shooting past that point, then hey, that's just icing on the cake. That's not to say that someone who is financially pragmatic is against approaches that have a higher potential ceiling if things break right. It's just that their focus is going to lean a little more towards the realistic, reasonable, replicable, and practical, which means they'll acknowledge the challenges and weigh the odds that face such an approach against its potential benefits before making their decision one way or the other. Because at the end of the day, a financial pragmatist recognizes that head in the clouds bliss is nice until the cartoon physics is turned off and you tumble back down to reality. They know that progress is not always a straight line, and it's okay to acknowledge that. The key is doing your best to ensure that you're generally trending in the right direction more often than not. We're occasionally going to break our budgets, either because we make some bad choices or just have some bad luck. The same goes for our investments. We're gonna pick some losers, or buy at the wrong time, or sell at the wrong time. It happens. And that's okay, as long as we don't let those mishaps warp our view of reality or of what we're really trying to achieve. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.